There are taxes you never see on a payslip, yet they skim your money, your time, and your attention every day. The rich know their names, track their costs, and design systems that legally sidestep them. By the end of this video, you'll recognize the 9 invisible taxes draining you and the plays the wealthy use to avoid each one, so you can copy them starting this week. First, the inflation tax. Prices creep, your paycheck stands still, and the gap quietly compounds. Consumers complain. Owners adjust. The wealthy hold assets with pricing power, businesses, real estate with fixed-rate debt, index funds that ride productivity. So rising prices lift their net worth while their debt gets cheaper in real terms. Your move. Index your income and your prices. Build an annual raise script, peg consulting or freelance retainers to CPI or value delivered, and convert excess cash into productive assets on a set schedule. Inflation punishes cash hoarders and rewards disciplined allocators. Second, the fee and friction tax. Overdrafts, junk fees, high expense ratios, pointless warranties, payment processing schemes, death by 1,000 cuts. The rich buy wholesale. They choose low-cost index funds over 1% advisory drag, use brokerage cash sweeps that actually yield, negotiate account analysis with their bank, and prepay annually for discounts when cash flow allows. Your move. List every recurring fee. Ask for a lower plan or annual billing. Migrate investments to low-cost vehicles, and set autopay to avoid late penalties. Every 1% you save in fees is a silent raise that compounds. Third, the convenience tax. Delivery markups, surge pricing, same-day everything, and a calendar designed by other people. Convenience feels like time saved, but often becomes money lost and time fragmented. The wealthy treat time as a profit center. They batch errands, buy in bulk, cook once for several meals, and design default grocery lists and reorders to prevent last-minute spending. They pay for convenience only when the value of the saved time exceeds their hourly rate. Your move. Estimate your true hourly rate and draw a line. If a convenience buys you less value than that line, it's a tax, not a tool. Fourth, the complexity tax. Scattered passwords, messy files, 10 subscriptions that do the same thing, and policies you don't understand. Complexity makes you error-prone and keeps you paying for mistakes. The rich simplify into checklists, dashboards, and standard operating procedures. They keep one password manager, one task system, one money hub with clear categories, and a monthly review ritual that kills drift. Your move. Close the open loops. Consolidate accounts, reduce tools, write your personal finance SOP, and schedule a 60-minute First Friday audit to catch leaks before they grow teeth. Fifth, the attention tax. Infinite scroll steals not only focus, but also the long blocks required for deep work, where all the leverage hides. The wealthy defend their attention like a scarce asset. They strip notifications, charge their phone outside the bedroom, and keep default working windows hostile to distraction. No feeds, no autoplay, no unread badges. They use technology as infrastructure, not entertainment. Your move? Rebuild your environment. Replace default home screens with a single folder, remove algorithmic apps from the dock, and timebox intentional entertainment. The goal is not grit, but design that makes the right action the easy one. Sixth, the interest tax. Credit cards at 20% are the most efficient wealth destroyer ever invented. Compound interest can be your employee or your warden. The rich flip the polarity. They never carry a balance. They collect rewards only as a rebate on money they would have spent anyway, and they refinance expensive debt into lower rate, secured, or fixed-term structures tied to productive assets. Your move. Automate full statements, negotiate APR reductions, snowball remaining balances aggressively, and then redirect those same payments to investments the moment the debt dies. Keep the cash flow habit, just change the destination. Seventh, the status tax. Logo premiums, yearly phone swaps, and cars that depreciate faster than you can post about them. The wealthy separate signaling from utility. They buy quality once, not fashion repeatedly. They purchase used when depreciation is steep, and they tie visible upgrades to invisible assets that pay for them. Your move. Rewrite the rule. Lifestyle follows assets. Every new recurring expense must be funded by a recurring cash flow source. If the asset cannot buy it, you cannot have it yet. This turns flexing into a scoreboard that forces you to build first, spend second. Eighth, the liquidity and opportunity tax. Cash drag seems safe, but silently expensive. Too little liquidity and you borrow at the worst time. Too much and inflation eats. The wealthy keep tiers. A true emergency fund for survival, an operating buffer for expenses, and a sweep that automatically moves surplus into higher yield accounts or investments aligned with their plan. They capture employer matches, max tax-advantaged accounts when available, and hold a small pool of dry powder for bargains. Your move: define your tiers and automate the sweeps. Idle money gets a job, or it gets sold for purchasing power. Ninth, the rules tax. Geography, entity choice, and income character determine how much the government takes after you take the risk. The rich play the game by the rulebook. They choose jurisdictions that fit their goals, separate business and personal through proper entities, convert some labor income into business income where allowed, harvest losses, use depreciation and deductions legitimately, and prefer long-term capital gains over ordinary income when feasible. Your move: learn the basics and get qualified advice. Optimization is not evasion, it's alignment. You are responsible for the structure you pick. Here's the contrast that matters. Consumers accept prices and hope for raises. Owners set prices and schedule them. One path makes you a target, the other makes you a designer. Do this now. Pull 90 days of statements. Cancel leaks. Call 3 vendors to cut rates. Move to low-cost investments. Block a money review. And practice your raise script. You'll stop paying invisible taxes by design.